Why business loans and funding are failing in 2026 and where liquidity is actually going. Hi, welcome in. My name is Michael with Viral Funding Solutions. I'm a business architect, meaning I know funding at a high level, business, real estate, personal growth and development, self mastery. I've built multiple businesses for myself, helped others build their businesses, and I keep doing that. I know how to design and create, structure businesses to helping them get funding and funded to growth, expansion, and scale. I review financials, credit reports, cash flow profitability analysis. I create business plans, performas, detailed project budgets. I'm in private equity, private debt, and I do more. I am the quiet, introvert, cerebral, brainy type person. So I'm best behind the screen, making sure the business is moving right and everything is being managed correctly, and then some. I've been in business for many years now, and I believe I know what I'm doing at every phase from foundation, startup, formation, to making sure that the foundation is set correctly, the concrete is poured right, and you have everything else being built on top of it and being framed correctly and structured, sequenced right. And in this video, I will touch upon some funding options. I do want to spend more energy and time going over cash flow and understanding that if you're a business owner, operator, founder at whatever level, you can take what you will learn today, and I'll be typing into a document you see right now as a share screen and showing you what to do with cash flow. Because there are a lot of people, business owners that take funding, have taken it, will take it, whether they've done it before or not, whatever the type of funding is, and they're in that mode and modes of thinking about funding in whatever ways, and they feel that their cash flow should be better than what it actually is now performing or would like to be performing as, and you want to know how to shape that, whether right now you're struggling with a business loan, with these merchant cash advances, high factor rate, then you'll want to stick with me because I'll be breaking all of this down and understanding why business funding is failing in so many companies and what's the actual diagnosis, not just the symptoms, but getting into the actual crevices of this and figuring that out. It's kind of like you're approaching a new trail that you've never been on. You're walking it or on your bike, your scooter, your motorized vehicle, whatever that is, and you have your navigation system, or it's just in here, you just are out here to have an adventure. You have to have some form of direction and know where you're going at the same time, even when you don't. And we're learning at each step of the way. And I've been there before, having been in business now for about 13 years and having what I believe to be mastered a lot in business, real estate, crypto, and more. I do more than just here's the funding type and here are the requirements. A lot of others can do that. I'm not saying it doesn't take any skill to, but where I come in is I am more in depth at what I do. And it's not about my words, it's about my actions. You hear me now, but I'm usually throughout my day not on phones. I am reviewing financials, building businesses, structuring them correctly, looking at the total fulfillment cost, overall total cost over amount of days to actual revenue produced, margin, what margins are we running on this, the acquisition cost, new customer acquisition, current customer acquisition, and plenty more, and making sure that that business is running smoothly longer term. not just short term, what we have to accomplish and what we need to do to have something lean. That way we don't have to do so much or any rework by moving things. Rework doesn't need to mean that you have to go cheaper or have a lower cost to your products or your tools, whatever they are. It just means you want to have the less amount of rework come that time, or know before then that you don't do something so massively large and then you have to come back and reshape your equipment or get a new piece of equipment, and now you're losing a lot of cash flow. You're expecting payments from clients that aren't coming in 30 days. They're taking more 60, 90, 120 days out. You're having government contracts. You look at subsidies and what's going on right now, a lot of affordability issues. So I'll be going into more detail and where all this liquidity is actually being freed up because of what you look at the quantitative easing and everything that is happening this year and loosening instead of being more tightened, that ROI, that liquidity is looking for an ROI. So there has to be more ROI being produced this year. And in quantities, volume aspect depends on the type of investments and where, if and when money is parked at what times. You're looking at the market and not trying to speculate so much and at all. And yeah, all that and where it's going, and why also in masking cash flow with debt and again masking the symptoms becomes a major issue and a red flag. And I just got sick and tired of seeing a lot of business owners struggling. And I've been doing this again long enough to know, and I've seen all the issues, and I'm even tired. And not in a bad way, in a good way. Like, not that it isn't challenging, because I love a challenge in anything, not just business, but life in general. I'm always challenging myself with my habits and my routines to be even a stronger and better human being in person, because that's my ultimate goal, is always becoming a stronger and better human being every single day, keeping that muscle going and doing the things that I have to do every day to show up for you and be the best that I can be. And so those points made. And if you stick with me until the end of this video, I'll show you what I believe is a much smarter funding model that is more aligned with having milestones, benchmarks, and capital performance, total capital performance, not just what your cash flow is, instead of getting so desperate about the funding you do have or will receive and are unsure about whether you can pay that back right on time, or you can, no problem, but then it keeps taking and dragging away your cash flow. So I believe this is a smarter model, and I'll see if I put it all together and it materializes in the way that it will materialize. But I've been doing and getting to a lot of things behind the scenes that you don't see. I am like that old man with the, that's me. I look through the outside and I am still young and I just want to help. And I've seen it so many times when business owners take funding, and also the source you take funding from. You have to be very cautious and aware of who you are getting funding from. I do not just mean that as like the organization, here's the funder and the lender. I mean, who, I don't want to use the word, is the broker, however, that an agent, a referral partner, whoever they are, a funding person, who is actually helping? Are they helping themselves more than they are you? Do they only know funding and that's it? At what level? Are they a funding expert, a business expert in real estate and other forms, and understand business in depth? That's what you have to pay attention to. And those are the things that I have built in my portfolio over many years. And it's just an ascension model that naturally has built after going through my businesses and different business models and having seen so many businesses, whether they receive funding or not. And there's more than one way that I can help. So if you do have any questions at any moment, leave me a comment. Let me know what has been your most hardest, most problematic funding issue and receiving it and using it now, and also in cash flow, what would you like to have more freed up and prepared ahead of time. I'll leave more information down below in the description too. So if you would like to get a hold of me, I'll have links down there. And that way you can access what I have and see my process and how I do things, because I'm not your everyday traditional funding person. I stay more exclusive and behind the scenes, because it's not about getting more clients funded. It's about bringing in a close circle of people and higher quality and business. And if I'm someone who aligns with you and with your standards, or wanting to increase those standards, like I help people do too. And funding is just a platform. Funding finance is just a platform that I can then spread my message to help you in more ways than one. Marketing and advertising, in management of a business, forming the business, real estate, looking at how things move like this in these parts, making sure this is here at this time, that you're not moving in the wrong direction, and all that. So a lot of what I'll be going over is in theory. And this is what actual people like myself, CFO level minded, underwriting minded type of people like myself, and who are very quiet, don't often get seen in public. Well, you have, if you've seen my other stuff, I don't want to do video much, but I'm here to give you value. And this could be a better way to give it to you than me always doing writing or math problems and just behind the scene. Every now and then I'll release a video. So the thing that I want to do now is bring this into view. And I'll write on this in a second. I just want you to see a little closer the title. And before I get to putting anything on the document, what I would say I will mostly be getting into on the cash flow side and just some examples and going over that with you. So how most owners think, they think about money in terms of just tracking their revenue. Let me put that here on the document, actually. I'll start with this. Make that 14-point font. So many business owners have this thing, and I was there, I get it. And how they think about their money, they will naturally tell me and or show me in terms of tracking cash flow, but they don't often do that. Some will. Most people, they start with, though, tracking their revenue. That seems to always be the front thing in mind, and the cash flow always being like the back end, kind of like a website that's being built, where if I'm staging a site or whatever I'm doing, is I got to create or list together what the front end is, and here my back end, I can do a part of it, but I can't connect everything yet, because everything that I don't have access to needs to be connected by a third-party database, a chain, or something else that's happening behind the scenes. So tracking revenue is one of those things that people do mostly when they start business, is they just start tracking their revenue and always optimizing for revenue and even more sales. But does that equal even more profit? And how much in additional net free profit is the business generating per month? What's its actual gross per customer and per sale? And we're going to get more refined on what I mean by per sale. So please stick with me. They celebrate their growth. Not that there's anything wrong with celebrating growth. A big issue is when they start celebrating their growth too soon, in a very premature way, and it might not be actual growth, that they are confusing with revenue, with their top line growth, with non-trackable activities that are not easy to measure and have data for. So growth shows in so many ways as ourselves and in business, and celebrate them along the way and know that you are growing in your businesses too. But you have to define what clear growth to you and your business actually looks like. Every industry is different, but most of the time you will have the same step by step as you're building and staging what growth is at that phase and at that level. After you hit a specific benchmark milestone, what kind of growth? How much growth did you have? Did you exceed over 10%, 20% of your goal in creating a site in then the first 90 days? After 30 days, you started now generating an extra 10 customers, and then you're celebrating growth in terms of volume and less churn of people leaving the platform and as fast. Is it a thing about speed and efficiency? Can you not have both? So what are you celebrating most and validating in your business that tells you that is proper growth? And then they also slightly look at profit. It might not be you're there yet, so you don't look at it so often, or you get fixated on your profit, so you don't just glance at it. You could, but you glance over it just by looking at it. It happens a lot. When the critical thinking skills are not there, it repels a lot of people to get fixated on something. When there's nothing moving much, it drags people away. Not saying that's always a wrong thing. It's you have to understand the story and the framework well before anything starts coming in. And any revenue growth activities are being produced. And what profit at that point is being produced and how you measure that profit, what that data tells you from that. Also, they assume profit equals cash. Not exactly it. And as we're going into this, you're going to hear me go more about cash flow, and you'll understand what I mean by what you actually have in terms of cash. They also will think that funding will smooth everything, not just one thing. They will smooth everything out. No. It actually does more amplifying your actual problems in your business and as an operator and or whoever that may be. And it actually exposes that business for what it really is. And I've seen it again and again is here's funding, whether it's creative credit-based, through cash flow revenue back, collateral, real estate, collateral, equities, and there are other forms. So those are a few things that I see happening a lot, and it feels good to see that revenue coming in. The profits that you see, the additional profit made from another customer and an increase in pricing. You think, I'm going to increase pricing now, and it's not a race to the bottom of the lowest price. You don't want to be in that category unless it's volume-based and is not such a heavily commoditized good and used. Unless it is, that's fine. But you also want to spread your revenue more evenly and have more than one revenue stream in most cases, because a product that is low cost doesn't mean it's less valuable in a lot of ways. It could mean that. It just means on what your model is that sustainable to keep doing that and then the price at the lowest? Or do you have another customer avatar and base demographically and psychographically speaking of clientele? What are the loads? Are you getting paid per load? What are the drop-offs? Where are the drop-offs? Where are the pickups and drop-offs? What are you distributing? When are you distributing it? Imports and exports. I've seen it all, and nothing surprises me. I'm always prepared ahead of time too when cycles happen, and I have to measure the market and forecast accurately for myself and for others. And I don't mind that I have to do that. I like doing these things. And I've always been a critical thinker and thinking a lot, even if I have to for many, that's okay. And at times it might be that I can't be that available, but I'm here to help. and I have projects to myself going on and things that I want to help even more people with affordability. It's not about the richer getting richer or the wealthier getting wealthier. It's about people who every day are struggling, not because of funding, with or without it. It's everyday things that are happening in the economy. And I'll get into that a little more. I don't want to get too off topic, guys. And again, any questions, please reach out. And in the description, I'll have more details. I have products that I've created. I'll get into that a little bit later. And you guys can check that out for mastering your cash flow. I have a cash flow mastery system workbook, and I have a course for it. I have actual videos walking you through every module. Every module builds on top of the next. I will show you how to critically think about your money and your cash flow. This is something that you will never find or will not see anywhere else, at least. And I had to make something because it's not about just putting numbers on a spreadsheet. It's about you understanding how to think and ask the right questions, the hows, the what, the when, the where, the why. So when something happens, you enroll into a program. I help you with merchant cash advance debt restructuring or whatever that is. Yes, that could be helpful, but you also have to know your cash flow because there's ways that I can help you rebound. What's happening with this business? I'll get into examples. So I just want you to know that. And again, what I said earlier on the profits, feeling comfortable and reassuring, you have to get away from that moat in that thought. And you also have to think less about being always the day-to-day operator, and you have to be the person who understands how to get and raise money. You have to become that person too who understands how to raise and understands where the money is moving. That's what I do. I'm in economics, understanding that market, crypto, tokenization, stable coins, you name it. I am doing that behind the scenes and understanding even more and going deeper and where the market is going, where you park things. You have mutual funds, you have a Roth account, IRA, rollover. If you need help. And another thing that I want to mention before I go into the examples is ultimately what it is cash flow. It's just cash flow game. That's what you have to play with chess. You don't have to know the game chess. I don't even play the game chess. I have to know that game. I like checkers more. But the game of chess, you have to be pieces ahead. And if you watch the competitors, I'm not even in that to chess like that, but I watch in their brain and how they're thinking. You have to enroll yourself into that moat of thinking. And so then you have to ask yourself the question, whether you have the understanding of cash flow, profit, revenue, and other parts of your business right, structured right, foundation, the middle, the back end, everything is built right to sustain and have proper structuring of growth. Can your margins now currently, can they absorb your payroll? Or in 3 months they will. Can they absorb your timing delay and delays? Because that's what all cash flow is. It's just a timing thing. Cash flow, timing, and structure. Those are two key pieces to all of this. And you can say that be the same thing for profits and revenue, but it's really about how much you keep and understanding, can you absorb what your timing delays on? What I said earlier, are you getting paid on net 30, net 45, 60s, 90? It's not even just that itself. Vendor agreements, suppliers, materials, tariffs, inflation, everything you look at. What is the delay? For how long is the delay? And how are you built now to absorb those delays? Can we do something in the intermediary that we can do? Not that we need to get more customers on board. That's not the issue. It's not more customers. You keep adding more fuel to the flame. It's not more customers. And so nicely and kindly, as a person I am in my character, I don't pressure anyone. You have questions, please reach out to me. And so understanding those delays and absorbing those delays, whether that be payroll, materials, you front load 50% of your cost to build, and then you bill after. Now you got to wait 30 more days to get the last 25%. What could we do differently? Is it that we have to do different? Is it that we have to have an extension of our business and serve a different clientele? Or it's not that. It's high ticket pricing. Is it upsell, downsell, cross sell? What margins can we run on each plan? What are our individual plans telling us what we're running on margin? How many subscription costs do we have? What are we absorbing there? What are we doing in each part of this in the business? And so I just wanted to go over that. And now I want to go into, sorry. How do underwriters and capitalists, just the underwriters, how do they see capital fitting? And making sure you're not putting a square piece into a round peg. I'm not saying it couldn't fit. You'd have to break everything, and then the stool and what it's holding it up, that'll likely be the last thing that falls. But it will, and you won't have no flat top to put this piece into. Now you have to replace the top part, and you have to fit it in with the bottom to make sure it actually stands on it. And then if there's something underneath the bottom pillars, what's been on the underside of the pillars? What's the foundation? Is there any line or lines running through it? Is it a component? Is it that you have to break a circuit? A circuit will break. So you got to understand all these things when it comes to forming everything in the business and making sure everything is running sustainably and, of course, affordably, especially during these times. And so a lot on our side, they won't look at so much, and I won't look at so much about how busy you are. Busy in productivity, difference. How many jobs are you taking on now? What are you doing now? If you're doing a lot of work, that's what a lot of industries have. Nail salons, beauty and hair salon, and automotive, construction, restaurants, is you have a clientele of people. What happens if you lose that clientele? For what reason? Can you absorb that timing and delay to recover enough, if not all? Or are you pivoting completely in a different direction and you got to execute? So knowing your jobs and what those jobs afford you, and the ROI, of course, numbers wise makes sense. An additional net profit, additional net gross and net free cash flow they generate from you. And I'm going to get into a different term today on margin. So please stick with me, and you're going to learn how to look and evaluate your cash flow better. And also down below, again, I'll have my cash flow mastery system workbook. If you haven't picked that thing up, you are losing out a lot of steam. And I'm telling you, as someone who's seen a lot of businesses and very ignorant, and there's a lot of ego and obnoxiousness that goes on. And that's why I tell you, as someone who's learned personal growth and development, self-mastery, I see it. And so that's what I wanted to mention. Also, what we do see, but not always do we need to care too much about and fall in love with, is how much your actual revenue is growing now. More, what would it grow to? Have you taken this funding, and the downside of what would happen if you couldn't pay it back? But without debt, you got to look at how fast your revenue is growing, obviously. What does speed tell you? Is there speed, efficiency, convenience? Is there the minimum viable product that you have to surface first and small batch before you medium, large batch it? What are you batching out? Why are you batching it out at that time? Incrementally, is your revenue just growing? Is it periodically will grow faster? What would make it grow faster? What do you need to do, add, do more of, improve, fix? What needs to be done to make sure and ensure that revenue is actually growing? And so I'm going to look at, and this is our mindset, is margin. I'm looking deeper than just the revenue. Yeah, but my business is generating 100,000 a month. I've seen 3 million, 6 million, even way more than that per month. And I've even declined clients who I don't want to work with. And what does it have to do with? It has to do with the individual mostly. Business is one thing, but it's the individual. Do I want to? And I'm a quiet type person, so I see all this. I'm inside voice. You're hearing me now. It's projecting. I hope you're hearing it. But I'll show you more as I type, where I'm going to show you more of in a second on the actual understanding of your margin. So understanding what your margin and margins in those layers, there's different margins in one set of layer, in one layer, excuse me. and you'll be able to see exactly the full story, general, broad to more specific margin, and what your margins could be running on. Have you increased velocity of execution of your sales? Are you on track? Is that your goal in 3 months to get to that revenue number? You're doing fix and flips. You're doing Section 8 housing. I've helped in so many ways that I can design all these things to make sure you're doing it right. The timing again, your cash. Are you timing cash inflows and outflows? Not just what's coming in, but do you know your expenses? Do you have too many accounts, receivable, payable, a capital type account, another business checking account? Money's flowing one way and going into another business. You're reporting it underneath the wrong business, and you're doing it to live out of your lifestyle. There's all of these things that I see going on in every part. So cash timing, I can go deeper into what I mean more by cash timing, and all these other things I can go far deep into, but I want to keep the video going. And volatility lines up with cash timing very well. That creates volatility from the timing not being correct, those inflows and outflows, and you hitting break even. Like, what's a business if the amount that goes in goes out just as much and right away? Like, how are you going to cover your overhead and your payroll, your rent? What's the first thing that goes? Kind of like what goes first when you think about home loans, mortgages, debt, auto loans, any form of business debt, healthcare coverage, whatever that means, and other ways. What would go first? I have the answer. I don't have to say it. You just keep it. You can answer if you want. When you start seeing the first thing that goes, that's less of a priority because you need cash flow in other areas, that'll go without question. That needs to go. It's very important, but what starts getting knocked off first and what can't be afforded? What can't be afforded to miss out on that you need to keep it so much? So volatility spurs from cash timing, and whether you are ahead of it or not, volatility happens whether there is funding, high rate, low rate type funding, better terms or not. But you have to look at all aspects of volatility that could happen in the business and see how you can prevent it. That's how my brain works. Is I'm always reducing risk and looking at preventative strategies. So you have to pay close attention to that. Is what's my preventative strategy that this won't happen? If it did happen, this is what happens with my timing. Here's how I have my current margin. Here's what my margin will be running on. And here, if I have debt or I will take debt, here's how I can service that debt. If I can pay it back faster, better. Why worry about having a loan out for 10, 20 years? If I could pay it back sooner and that interest accumulates and occurs even more with more time. But the thinking when the math isn't lining up, or if you need help with that, I'm a math person. So let me know. And I'm an academic student, in case you wanted to know. I come from academics. I played Division I soccer. I know what hard work looks like. I was a chemical engineering student first, then I went into business, got my degree. I've worked construction, manufacturing, the actual field position. I know what hard labor looks like. Being in the blueprint room, warehousing, once a ramp agent in a courier administrative dispatch. They're not like that, but I had to do it. Sometimes you have to do what you have to do. And to a financial logistics position for a huge contracting company servicing HP and others, doing a lot of stuff behind the screen, database, Excel. There's budgeting, inventory, ordering, shipping and receiving, lifting media boxes from time to time to deliver. And I was tired. Not getting paid what should have been getting paid. Stayed there for stability reasons, post-academics, and kept going, and they eventually relieved like 50 plus people. I'm one of them. I have to go back on unemployment benefits and food stamp cards. That was a while back. So I know the struggle and not having to seek another job, another 9 to 5, another career. I've been there, done that. I'm very well experienced at my young age. I'll say 33. And I have a younger brother. I'm very family oriented. I love to fish. Washington State, And I just don't get in people's ways or the conflict like that. That's not for me. I'm here to help person behind the screen and doing a lot here, ensuring that things are going to be running smoothly. So I just wanted you to know that. And the next part of that was, like I mentioned, the debt. Understanding that debt that you have to service before you get the debt. What other debt do you have? Are you trying to refinance it, consolidate it? How are you trying to use a cash out refinance situation? Are you in a stock market position? Are you in a buyout position? Are you in a place that you can liquidate funds as easily and be able to cover that debt and any additional debt that services or more debt that you'll need and ongoing debt? There's differences between that before and after and during having that debt. The predictability is understanding, can you easily predict how you will cash flow? Can we easily predict that on that cash flow, you'll be able to service the debt, the ongoing cash flow? What are the deposits? What's the actual deposit? What does it actually tell me when I'm reviewing bank statements? All the time. I review bank statements. I review financials very closely, and I see it. The differences, revenue, cash flow, complete difference. Well, you have decreasing revenue trend here. Why would anybody lend you 2 times that amount when you have your lowest month in the last 4 months, 3 months, or 6 months, whatever I'm looking at? And that's the month where you had the highest revenue. And then it's now the most recent month, if that's December or January, or when that be at, it's a big difference. So I don't see any recovery. Where's the recovery coming in from? So you're just going to add 5 more people and more appointments, and because your history has shown you that, but have you actually proven that works? And is that model proven to work right now? So there's a lot of things that have to be looked at. And if I'm lending my money to you, I'm already an architect at what I do. So I'm going to thoroughly look at everything before I give you anything. And so what I'm asking myself with all this is, if I added, or a lender or funder added pressure to giving you funding, by pressure, I mean by funding you. If you're getting, here you go, deposited, if that's adding pressure to your current predictability, volatility, your debt service, the marginal timing, and more, then what already is, if I add more pressure to that, will it break? It's not will it, it's how soon will it break? And what's the speed of recovery? Have I given you an additional, or someone giving you an additional 10,000? What's the speed to recovery? If something happened, these are the 3 worst case scenarios. I give you this to start. I need to see a return of capital being, and I need to see margin. I need to see performance benchmark. I need to see this met. All your use of funds has to be for one thing. Do you need the total all right now, or can we small batch? A small batch. We don't have to large batch. Time yourself and learn the art of financing and funding, and even financial literacy and more. So if I add more pressure, or a funder or a lender adds more pressure, traditional, non-traditional, conventional banking, that's not the point. The thing is, does this business of yours, multiple businesses, if the money's running through one in a management company, invoicing the operational company, whatever you have going on, is it going to stabilize? Not that it has to recover, but can I stabilize your business? Does it make it and improve it? Does it give it that extra juice that now I know you'll be able to pay back in faster and for other reasons? Or will it break? It reminds me of when I was in my engineering classes. And this is even back in high school when I was putting together a bridge and with my classmates team together. And here's what I did. I added this here. This base needs to be like this. We were only given so much in materials to use. I tested a few times when it would break. I actually wanted it to break, so I knew I needed to change this to make it better. And it's just a marriage you have with business. It's like a baby. It's like you have your thing here. This is the most precious thing that, my precious, you have. Yes, I'm not the most entertaining person, but I can be dry humor. And I just want to be sure that you're best off and you have the best advantage going into your market and seeing what your competitors are doing and doing better. So if you're thinking about all this and funding, or even if you weren't, I believe you should be. In this video, if you want to share it with anybody else, please share it with others that can find value from this, because I'm at that point too where I see a lot of business owners struggling and dragging through into 2026 so much. And I'm just here to help. So this framework and everything can help save a lot in terms of cash flow, revenue, energy and time, and plenty more. Okay, so a few more points I want to make, and then I'll start drawing on the document, writing on the document. Liquidity. I did say I'd mention a part of liquidity, so I want to get that done first before I go into then the example. So I'm going to give you a point of margin and what you can use right now. And again, down below is my cash flow mastery system workbook. Check that out. It's well worth your energy and time. If there's anything that I would want to have if I were in your position, not avoiding it, because people duck a lot. They tire kick. I see it. And it's natural. It's more natural when beliefs and when the growth in someone hasn't been there at all. I know what that is like. I do. And so in 2026, I'm not going back so much to 2025 because I saw all that and what I was participating in. And a lot of things happened there. Pullbacks, drawbacks, endowments. I saw a lot in different spaces and what I was able to be a part of, thankfully and gratefully. And so a lot of things like inflation right now, what's happening, a slow growth, a slower pullback, and what we're going to see. But a lot of costs out there in consumer sentiment is still high. Like that hasn't changed. And it will still be a struggle for many. And that, again, as an affordability being an issue. Another thing when I speak about the micro and macro part of this is labor. Labor is huge. Labor tie in employment, tie in wages, tie in a lot of different ways employees and employers get paid, individual owner businesses, family ran businesses, and looking for labor in all different capacities. And having a reset on labor, like we need to pick that up, and there needs to be more of an emphasis on that. But how permanent, if we increase, will that stay and will be sustainable enough? That's yet to be determined. So a lot of businesses and current employers are struggling with labor. We've seen some slowdowns and layoffs and things like that, but what we need more of is quality labor, and that's not easy to get and find when you look at baby boomers and different I lost the word. Generations. Who's coming into the market at what time, and is the pace keeping up with where inflation is? And are people going into the trades? Because that could be a big focus, is the trades, and that's what people are looking at a lot more right now than a traditional type of education, everyday academic. So a big issue, and I'm seeing this a lot because in partnership and in seeing this and in collaboration are with insurers and insurance companies and the holding of things and seeing things before they go in. And there's a lot of that happening right now, especially in January. I don't want to get too much into detail on insurance right now, but I'm seeing a lot of it. Rent is only increasing. There's been stability and some laying down on, but where rent is right now, where mortgages are, what's become more expensive in the housing, in residential and commercial, business, non-business, there's a lot of things. Property taxes, and going into the pricing strategy of people allowing someone to rent and what they're willing to go down to and up to and sell at. And there's all these things that are happening, not just in the rental space, but in many others. And then what I'm seeing is with utilities, those costs go up and they will stay at where they are. We have to pull levers in other places so that can come down and more immediate, but we have to make do with what we have and continue to. And you can only cut so much in other places to keep your utilities and your bills and any premiums and anything that you have to offset with utilities. The rates out there, yeah, we have seen going down, which isn't always a good thing. When you look at inflation as what goes up must come down, what goes down must go up, and all that is still in an environment that there's still a lot of pullback, but there will be more businesses who are getting into debt. And that doesn't mean that it's always a good thing. That could spur a lot more credit challenges, a lot more total debt. We look at GDP growth and where that is, and relatively well compared when you look at year over year. So there's a lot more things that will become more sticky, and I hope to that be on the better end. And only time will tell with those. In the banking world, in the finance world, banks are drawing away from even issuing more capital. What happened a lot the last couple of months, and I don't want to start naming certain banks, but I see a lot of the internal working, and I know what's going on. And with all my banking relationships and insider information and understanding this world well, you have to allocate a lot of capital to meet your goals with a lot of banks. And that money needs to move. And when it moves, it can move in large chunks. A lot of the time, it moves to in smaller bit by bit testing and putting that money into different parts of the market for a return. Now, a lot of that money that will be getting moved at higher quantities because of you looking at the quantitative easing, the balance sheet of a lot of banks, and all of the stuff that's happening is that money is looking to make a return on its investment. So that money is going out there to fund a lot of things and projects. Look at AI, data centers, rooms. You look at the technology that's fusing in with all that in AI and serving as a front end and back end, as is the AI too. And we've yet to see a lot from that. And that's a whole different topic that I can get into, but I won't do that today. And I just wanted to mention that with banks being more conservative on their lending strategy, and also costs and fees you could see being up. So it spurs out more people. Even I've done more in looking in the direction where most people look at is community credit unions, and looking at things more regionally. There's nationally looking at the top tier banks and understanding what's most important is your classification of business and knowing how much you'll deposit, what you'll keep in an account, and so much more. And also having more of a conservative approach, as banks tend to have more of a conservative approach as they do. And then on the private debt side, it's still cautious. It's still not moving at the speed that I would have liked it to by now, but it's okay. That you need to still see and feel the market out. And with all this AI stuff, and then you look at the stock market and crypto and where that's going, and you have to be very aware of high risk, volatile, digital assets, hard assets, real world assets, and soft light assets. And what all that means, I'm not going to get too much into detail on, but just knowing where you can tie your liquidity and not have your liquidity tied into and for so long. So understanding that, but private capital is the middle piece, and it's what opens up the bandwidth for different investments to go through and out. So think of private capital fusing as the middle center, the nucleus fusing and having everything as its arms on the outside. That's what private capital is in the middle of it. And being able to move money in one way so it goes out the other way, and looking to get multiple returns, index funds, annuities, and more to place a safer bet in than having concentrated risk on one asset and one portfolio. So I do see a lot of liquidity again that is open, free now and open to go out there and be pushed into the market. But it's not flowing evenly. And that's still something that I need to see even closer and make sure that that liquidity that is being freed up, it is as flexible as it has to be. Give me 1 second. It's on a live. And this is my other office room, so this is one of the chairs. And I had to close the door because I can start hearing a little bit, and I didn't want to get too loud. I can hear, you might not have been able to, but I can hear the sound. And so I didn't want it to come through as I was about to say something. So I'm always consciously aware of those things, making sure that that's the case. I mean, have like parents have the keys if they ever come and visit, the brother or whoever that is. And I'm expecting them to, or they showed up. And I don't want to have that disrupt anything. They come over to my place or anything like that. So yeah, just those things. And so where is the liquidity then going? As I mentioned, like I'm still set to see how flexible that liquidity is when it enters the market and how free it would be to move. And so I want to be sure of that first, where it's going. And businesses with clean cash flow will win because they can absorb taking that liquidity in for any investments or any investors they're gonna give shares to. They're going to be able to absorb that liquidity risk much more cleanly because they're going to have more available liquidity with that they get, and or they already had liquidity, enough of it to then be able to put back into the market. So that's it. And then the next thing I'm going to get into, and this is what we're going to go into in a little bit, on the contribution. You're going to hear me say the word contribution and another one in a second. And that'll tie a lot of this together, and you'll have much more of a clear understanding. So businesses with predictable contribution, margin, and margins. And I'll explain that in a moment, what that is and the difference, what you would subtract, and be sure that you know what you're running on in percentage, and giving you some examples. So please stick with me. And then understanding that there's a lot of asset retention and on the K-shaped side on people who are holding a lot of assets and who are winning right now and not liquidating it for any kind of event or sell-off. There has been a sell-off in some type of property and properties that I've seen a lot of, and to trade in exchange for one or more businesses and how you price that business in its highest profit. And if a business was incurring a loss, it was negative and negated, why would somebody want to purchase that business? And there are more details to that, but understanding assets and having assets in your current business or in a different business, or how you acquire those assets, that will be very big in this year. And seeing who are the ones moving more cash easily, those that have higher valuable assets. Even if the intrinsic value or the inflated value of that asset is so high, they're still winning. And that's something else to pay close attention to. And it's a lot going on that side. Doing performance-based capital. And I mentioned a little bit about this earlier, and sticking with me until the end, because I will mention more about performance. Yeah, and I could hear through the window here. Might not be able to hear, but I can hear a little bit. It's getting louder. And it doesn't always come through this. And there was another window opened up just right outside the door. I want to have closed. That's where the sound would be also coming in from. And so understanding that where the capital is being infused, where it has to go make a return, where are these assets? Are these assets locked up? Why are these assets locked up? What are you trying to do with them? What's your overall short and long-term goal? Are we in the short term or in the long-term market? And that depends on a lot of things. But yeah, performance-based capital too, as I said, is making sure that your business is performing. So when you take on more capital, it's on the right track. and like little to no questions asked about where that's going. And those who are going to win a lot are those operators who stay or get even more or get disciplined on their reporting. So you have to know your tracking, but you have to also know how to report and when to report so you can track those things. Reporting is fundamental. A lot of people know how to or will learn how to do that, but understanding what those reports are telling you and not just looking at it at a glance and your profit, like I said earlier, on your profit, you're just glancing over it, but actually getting fixated on it and what's the story it's telling you and those things. So as an operator, whoever that is, if there's multiple operators in your company, in your position, in your role, making sure that you and or they stay, all of them, not and or, you and them stay disciplined. And if it takes more than one person, you have the person as you are in your corporate structure, whatever that is, and they're reporting to you. Think of it kind of like you're in a room and here's our report, Mr. and Mrs. Here's our report. If then this, because I drew the conclusion on this and my reasoning behind that is, so we have to get prepared for XYZ like this. But interpreting that, if somebody were to bring it to you, let's say you are in the day-to-day, you are making the final decision, you got your report and reports in front of you. Here's our budget allocated for the quarter, for the month, and we're projected to. Do you know how to report that accurately after you meet your next goal and your next milestone? And what does that report tell you? So what I'm also seeing in the other side is where the, how does I say, equity, I can say where the equity is and not going. I could tell you that too. But where the liquidity is going, that is not going into like operators who are running on thinner margin. So if you're in a current business now or looking to acquire a business, you have to pay attention to what margin and margins that business is running and what's the fulfillment margin. What is the cost accrued and what does that take away from my margin? When does that take away from my margin? So you're not running negative in a deficit. Are you running 4-to-1? So for every $4,000, you incur another $1,000, and is your cost of 1,000 going up every month at 1,000, 2,000, 1,300, while your revenue is actually going up cleanly by double the amount? So now you have 8,000, 16,000, or per quarter. That's your goal to get to, but your costs that you added that are variable fulfillment costs, any updated software, things that are becoming more expensive, and you need to cut back and smoothen your ship. And if you're riding the ship, keep riding the ship. So that's what I'm seeing is those who aren't going to, not want to say make it, it's not going to those businesses. It's not going back to your current business so much because it's already a thin margin. So how much more cash flow can you actually, and how much more liquidity can you create when there are lower and thinner margins? You spread out more, like I said earlier, and there's different ways of doing that. When the cash flow is volatile, again, inflows and outflows, at what times that comes in and when it goes out, in when is your cash flow volatile the most? If we can look at that and say, well, it's only seasonal, but we outperform other times of the month, then that can make up for it. And through a slow season and a peak season, you keep going up, but you don't want to become so then transactional where now you have to make up for that revenue loss, that you have to get in front of as many people as you can or start selling off assets or more services just so you can have more cash flow. And that only works for so long. And if people in your market are not going to you for that service, they can go somewhere else. There's a lot there to be discovered. So high volatility cash flow, that's not where a lot of the liquidity will be going in investments. And how do I know this too? Because I also partnered with a lot of investors, know a lot of investors, big time. And on my side, a lot of owners, matching investors to owners, vice versa. And there's two different modes of thinking with us, with the investment side, with the owner side, and how the thinking is. So that has to be matched in the realistic approach and what can be done. There's a big difference in drop off with the two. So I wanted to mention that with high volatility, and there's so many examples I can mention, like financial free cash flow, investment cash flow, derivatives of that cash flow, discounted cash flow, who's getting what in what cash flow, who's getting what if there's an additional amount of revenue generated every month, how much of that is profit, what am I getting paid with profit, how much of a percentage am I expected to get paid out, and is this consistent, and is this stable enough to consistently be paying this out, and then throughout the year, what are my forms of, is it revenue share, is it on the build out of the construction project, is it also equity based, are there tokens involved, what are the different ways when you communicate that I know how to figure this stuff out? Is it preferred equity? Is it not? Why would it be that? What is a good percentage to give up? Like those are the things that I solve. And again, as at the root of the business architect, I'm just a problem solver, and I'm here to do more than one thing. I'm not a one-trick pony. And so now comes the stacking of the debt. There's always a debt portion to these I want to add. Is stacking more debt becomes volatile quickly now in this market. People need more working capital than they need just to grow and expand. People are still from last year and years before struggling, and they're just getting over, not even into the finish line. They're just not even a mile in what's the way that I can resolve this debt. And if I take any more debt, I can't service that completely. And then I'm going to have to go negative on my other account. Like there's so much of that being calculated these days more than anything. So it's not as simple as taking like these cash advances with these high rates. Yeah, you could turn it into an interest rate. People won't always tell you or want to explain that to you. I've got you. I know what I'm doing. I'm very transparent. I have no ulterior motive or motives. Nothing. I'm just very kind, nice person doing a lot of things out of my heart here that I don't even get paid for to do, and I don't ask to. And I only get when you get funding. That's the way that I get. In most ways, that's it. When it completes, like what's wrong with that? When I'm doing a lot of this other stuff that others would likely charge you for, here's an extra consultation fee cost on top of that, and stacking this on top of that. And I have to be able to justify the work that I've done because you weren't doing it for free. I understand both sides, but what I give is a lot of my value, energy and time, a lot of my, and a lot what you won't hear out there, what you can't just do a search on. And that stuff isn't easily found and not even online to find. And you can't replace experience with an AI. You can't replace these motions with AI and it tell you that that's what you should think or feel. No, it's what can I add on top of or not use it at all. But there's a difference in understanding that it's from your experience. So when you're business stacking or adding just one form of debt that isn't bad necessarily, it could be good both ways. What are the gaps or gap that you're covering? How many more gaps? Will there be small or large gaps? If we try to fill this hole in with this debt, does it open us up to here? Is that worth the risk? Is it worth us taking this debt now that we're going to front load a lot of debt here, but we won't be able to pay it back fast enough? We won't have enough left over to pay and make payroll. Do we have enough to cover those gaps if those went back a little bit? Because we're at a layoff phase. Do we do that now? How do we recover? But then how do we, in the temporary time we have, is supplement that spot so it doesn't look like we have that gap at all? Is it a business debt related reason? Is it a consumer debt related reason? Is it something else? So that, and then with or without the debt, there's always a thing I say with high churn, low churn, customer acquisition cost, lifetime value, lifetime gross profit value. Don't want to get too much into that, but high churn, people are not staying long enough from those people you brought on average, how many of them or how much in total of those current customers actually leave and cancel your service and services. They're on a membership. Can you replace them? How can you? Why can you? What makes it so easily replaceable? Or why would you have an extra 30 people when you're only running with 15 people now? How does that? Can you show me the numbers, please, so I can see exactly why that is? Ah, that makes sense. So higher customer acquisition costs than normal. That's a normal thing nowadays. Is there's a lot more higher customer acquisition costs than there has been in many years. Running advertising costs and other ways, understanding when you're building out your platform or your business is coming back to tracking that even more accurately over a data set, over a small to large sample. And then again, with me saying cash flow and timing, there's always poor timing. So a lot of liquidity not moving into businesses, and not just businesses, but in many places that have a higher churn as expected, you see with others. With higher customer acquisition costs, that has to be very well aware because that has been increasingly growing across many industries. And then the timing. But with higher customer acquisition costs, if I can absorb the costs and still have enough margin made that I can cover everything else, I'll be fine increasing my customer acquisition costs a lot as long as I have more coverage in other places. So money is moving, and it's just moving upper echelon into higher quality, and it'll make it stop. It'll make it stop in places that you wouldn't have thought of. How do I know? I'm seeing all that. I'm on both sides with the affordability, and I'm seeing with the wealthy and the rich, like higher class and everything, more than I am, and all. Like I see all that, and they're light years or years ahead, and where I'm going and more. But at the end of the day, it's about helping the people who need more affordability. It's always been my thought because I know what it's like. I do. So another thing that I did want to mention, and I know I'll come back to the next piece in a couple more. This is very important that I get this out of the way before you start seeing more about, here's the exact example, because you need to know story. You need to know more the framework. You need to know what the problems are, because just doing the numbers yourself doesn't make it any better. You still come back to the same thing and don't know how to critically think about something. It just, and I see businesses everywhere bankrupting and different types of filing for bankruptcies. And if I can be that person that helps you. So we spoke about where the liquidity is going, where it's not going. And then masking symptoms. I spoke about diagnosis earlier and understanding the diagnosis for funding, for non-funding related reasons, debt coverage, debt gaps, and much more. So a lot of businesses, they mask the debt. They don't have debt, but they mask their problems. And a lot of it has to do with, like, I don't want to have to look at my numbers. Like, I feel so embarrassed. I get that. I understand. I've been there. I get it. And that's not the only reason. But you see a lot of things and you just don't take the time enough to look at it. And it'll fix itself. The debt, the cash advance debt, I'll figure that out next week. I'll send Michael an email. And you don't tell me when. It wasn't a priority. You don't have to tell me it wasn't. But it just wasn't a priority. Don't have to give me any reason. I've been in this long enough to know when excuses are made. And if it was a proper excuse, that's fine. I understand things come up and they happen. I didn't plan for that. Or it just came up. It happens. That's life in business. But at the same time, is making excuses that recur and occur again over and over. I don't want nothing to do with that. And so taking the time to understand the total debt and the amount of debt at phases that it takes with the total debt, the amount of phase debt you're using. So total and then phased. Order of operations and how you're using that debt at every stage is what I meant. And taking that debt again to cover gaps. And I could have said cover gaps in forms of it not being timing, gaps in terms of it just being longer, bigger gaps to fill. But for timing is what you want to start as a fundamental, is understanding the time it takes to cover those gaps with that debt. And when you're taking too much debt to cover that time, things can also spiral. If that return is not giving you much or anything, and just covering timing. It's just before I get paid, or before, like, if I wouldn't have had this, I wouldn't have been able to keep a relationship and vendors. I get that. But also, you got to be careful with those things and make sure it's a very calculated, assessed risk. Also, another thing that I keep saying is they're taking funding to cover what's margin. It's not so much of a cash revenue sales thing, and it's more of a revenue and sales thing than it is a cash flow thing. So you're taking funding to cover your margins because revenue decreased for whatever reason, sales decreased, and you're not making an additional gross and net from each person, that you're taking that debt just to make it easier and keep your business running. And that's okay if it makes sense to do. But now what's going to happen is your cash flow growth, whether you had it or not, is going to rapidly decrease just because there's nothing coming out from the front end, like the hose, and you have it tangled. Like, you got to turn it on, and the water front end, back end is the valve and everything that pushes the water through. So you need to untangle that. And there's a lot of things that happen in the business that's hard to untangle. It's too already tight, can't get it out, and it's lost, in a lack of better words, its bearing. It's lost its pressure, it's lost its design, its form, and so it won't hold the water in well, and it's leaking. That's what happens a lot. You start to see a lot of money cash flow leaks, more than anything on the front end, the margin. You start seeing more cash flow leaks. And so they start stacking more. Again, that comes back to the stacking again, over and over. That becomes an issue, and it's really your obligation now to. If you don't, then it's like, I won't make payroll for the 10th time. Well, I've been making it, but barely, but I can't. I'm not making it up somewhere else. So I need to keep taking that just to stay afloat. And don't confuse what repairing something is with relief. Short or long-term, temporary, or whatever that is, don't confuse repairing with relief. Relief doesn't mean that you're repairing anything. Repairing doesn't always mean you're getting any relief from something. It just has to mean right, because it could mean relief does mean more better repair and better repair going forward. But it just, there's many examples I can give, but it just depends on what that means. Like a car you're getting fixed and you got the relief from funding it to finish that project and get it out. You needed some more materials to finish. You were over budget, but it helped, and you got the car repaired in that case. And you may have lost some profit to sell it at, but it's fine. You got 2 more projects lined up, ready to go. We're going to make about 25% of that in the next one within the first 30 days of putting this car together. So then the rest of it, we'll make a great return on it and get everybody paid out, or whatever the thing is. So I don't want you also thinking about what debt is not like more oxygen, even to say carbon dioxide or any element, chemical. What it is, it becomes pressure. The whole hose again, front end, middle, back end, when you open, pressure starts somewhere and it gets released and the water flows out easily. So pressure is built up. And then if you increase the volume, pressure then decreases. The accelerated pressure, that's another topic. Not saying that it deaccelerates all the time. I'm not going to get into all that stuff. But it's just paying attention to those pieces. So the pressure won't fix the overall infrastructure and structuring of the business and give you any kind of better access or navigation to what you're doing, or those who are on your platform given navigation and access to what you're giving them, it just adds more pressure for you then to perform, and you might take your attention away from what's most important. It happens so much. So what you should look at is, do your expenses, are they, better way to say, are they landing like a landing strip plane? Are they landing before your revenue does? So ask yourself that. Are my expenses coming in for a service rendered, obviously, but products, what are the product cost of goods sold? What are the fixed variable cost? What went to make this product? What are you selling it at? What's the margin? What's the spread between that? What do you keep for versus what you give? There's a lot of things that I can give you examples on that. So understanding, yes, okay, move to what are those expenses and how much of those expenses? Which ones do I need to take care of first? What do I need to prioritize with those expenses? Do expenses hit before your revenue, or do they land before your revenue does? And are your invoices easy to spot and see and when they'll arrive? And with that, does your payroll run before that? Does your payroll occur, or is it, how is it, weekly, doing something daily so it can turn out weekly, bi-weekly, monthly? So is your payroll running and taking too much cash flow, cash, available cash, you have to put aside before any of your invoices are cleared? And that's just being cleared. Another thing you can ask yourself, and that I ask myself too, is very common for everybody to do this, probably the most simple one of all of these, is, do your debt payments, are they landing daily and or weekly? Is it a monthly, bi-weekly? Is it sporadic? Is it variable depending on your sales and how much you generate and who you're paying back and what you're paying back in what form of that debt? A percentage of, what's what I mean, like a percentage of what, your daily sales, your weekly sales? Does your growth in your increase of each additional input you give, does the growth being your output, does that increase just stress tension in the business and or yourself, instead of actually lowering it? Does it lower it more than it does actually increase stress? And stress comes in many forms. So just understanding that if you're in growth, expansion, scale mode, is this stress tested enough that it would work? Or is it increasing stress in all the worst ways and it would break, and or the person breaks, instead of it becoming reduced? I'm adding this now. Am I able to reduce this? Not, they're two different things. Is it going to reduce it, or is it going to increase stress capacity? Where now, yeah, I have a bigger range of stress that I can handle, but that volume of stress just increases. It's like turning the dial up on the heat or on the cold, lowering it. It's so chilly and it gets so hot that you can't bear to be in that room any longer, that you need to make a change. So a few things I do want to get into now on the screen. Sorry for going on this long, but I believe this is something that you would want to know when going through all of this. So I know I didn't write much earlier to the tracking of the revenue that you see on the screen, and I could have listed everything else that I had to, but I wanted to save it for understanding the different formulas. So what I want to mention here, numeric values, metrics, we'll just say formulas expanded. The first one I want to start with is your, cost of goods sold with revenue, so your gross margin. So when you have gross margin, I always put the equal sign, and then you're going to do so your revenue, which produces your gross margin is equal to your revenue minus cost of goods sold, then divide that by, which is the slash that I put there, not a division sign, your revenue. The next one, this is the one I'm getting at now, and you heard a little bit about it, is the one that most people don't know, don't understand, is your contribution margin. You look at before and after costs. So you have to pay attention to what are your variable costs. There are fixed and variable costs. So I'm going to take my revenue, subtract that by my variable cost. So total variable cost, you add them from each line item you have, how you're recording or on a spreadsheet or software, wherever you have access to. And I would chunk it up by each category and understand what those variable costs are per category of service, of revenue produced, of fulfillment costs, on anything that has to do with it being a variable cost, because these can be low, they can be medium, they can be high costs. And you want to have that taken care of even before any fixed costs, because those are the things that rise up the quickest. With fixed costs being so fixed and predictable, but that also can be very costly too. So variable costs, how long, how high, how low, and am I introducing these two correctly? Something to be paying attention to. So next one is net margin. That's a very simple one. I'm sure you understand that. And simple to divide net profit divided by your revenue is equal to your net margin. I can say a lot about that, but I will be moving on to the next one. This one I can represent it as a delta of free cash flow, like the triangle of delta free cash flow, and do a few different numbers with. But this one you have free cash flow, and that's equal to cash in. Hopefully that's plentiful of cash in. You're going to subtract that minus your cash out. So outlays versus inflows, inflows versus outlays. And then now you subtract your debt. You don't want to forget that. Don't just take your free cash being your cash in minus your cash out minus your debt. And again, the one that I believe is extremely important is that one. There's more different models of cash flow. This I'm just going to leave it as a general one. So with that part said, on this next one, let me actually bring this closer. Like that. So what I want to mention a little bit before I go into some of the examples is your gross margin from your revenue. That is your pricing power and strategy. You should know that with better pricing, you get better, most of the time, you get better gross margin, and you can keep repeating those sales and with the same type of customer, and find more of the same type of customer elsewhere. Your contribution margin, this one up here again, I'm actually going to increase size, red. That one there is, again, your debt isn't your oxygen. It isn't even a CO2. It isn't that. It's pressure. Debt is more pressure Like we have the hose again. Where's the pressure start? Where does it end? Can it come back, reverse it? What happens with that pressure? What negates pressure? What's the opposite, indirect and direct proportion of pressure? Volume. So your contribution margin in this case is your oxygen, the operating oxygen to be specific. So this is the piece that most business owners miss, is understanding that debt is not exactly oxygen. Neither is it bad, but it's not your operating oxygen you add to the vehicle. You're going to put liquid in the vehicle. You need the windshield wipers with water. You need your motor running right. You need to put the right oil in it at the right times. If you're changing your own oil, I used to do that a lot. Or you're bringing it in and you're getting it changed, making sure the engine, everything is lubricated right, and running well and not on fumes. And it's not breaking. There's no spots in and little bubbles that build up, and just making sure everything is running clean. So contribution margin, that's what it is. And then you have your net margin, like I said. That's what sustains the business. That's like the framework, the infrastructure being built of a business. That's your net margin. And then your free cash flow, like I mentioned in your delta free cash flow and more, that is going to best determine your business being sustainable and survivable with or without the debt. So this right here, with or without the debt, determines sustainability and the rate that it's sustainable and the survivability of it. The contribution margin, like I said, over here being the oxygen, the input of oxygen into anything. When you think about oxygen and how we use oxygen. So that's what I wanted to mention for those parts. And then what I want to get into now is the examples. In my mind that I have a few from different industries and in no order, but what I want to start off with is, let's say I have a restaurant, and restaurants, they are awesome, valuable, great worth for communities, and bring a lot of people and families honestly together. Who doesn't like going out on a Friday weekend or before that and having a great meal or whatever that is, just going out and to be in a social setting. So again, the one that I want to get into right now is on the restaurant side. And again, before I even start writing on that, there also is a lot of high volatility with a lot of restaurants I'm seeing right now. It has been an industry that I've been helping for a while now. I see their margins. I see produce. I see costs going up, beef, import and export, farming costs, what a lot of farms aren't doing anymore. And yeah, so in that regard, restaurants are still a viable solution if you're thinking about starting one, but I would not go in that direction. I would do my best not to. And because, again, they can be very volatile and the margins are already thin. And if you lose your consumers, how quickly can you replace them? That's not something a lot of restaurants can do. And specifically in an area that it doesn't allow the owner and the business to do that, is it becomes more troubling. So with that said, the revenue of the current state of this type of business is we have the monthly revenue. Let's just say, for example, this is a stronger performing restaurant. Call it a Mexican restaurant, a Chinese restaurant, or where your imagination goes. So the monthly restaurant is producing, let's say on average, at 300,000 a month in revenue, and not looking at that as just what our lowest or middle of the way number on our scatter plot is. Let's just say monthly revenue in this case, it's on a high month, so or a high average of a couple months. So we're generating consistently 300,000 in monthly revenue. So I need to account for certain categories. I'm not going to say this is only limited to this. Depends on the restaurant, and this is the exact amount that it'll be in ratio to your monthly revenue. But let's say you have, for purposes of this, we could do 124, 125. Let's just do an off number. So I have food costs of goods sold being 123,000. We're just using round numbers too, just so we have them. And what is our GM? Or I could write it like this, as you see it commonly too. I could even put that up there like that too, but put GM there. Let's say for this business, and this is rather high when I consider this in this type of revenue, so there's a lot that had to be added to even producing that kind of gross margin. The type of product it is, the sellability of it, the market availability of it, the supply and demand for it, if it's a high cost, or there's more high cost in this place and it's more luxury restaurant, it's mocktails, cocktails, all these different things, and there's enough space, and the limited menu or not limited menu, rotating menu, it could be a different amount of things and how the product is sourced. Let's just say we're operating closely to 60%. I can round it that, but let's just try to draw it into like what real world example would be if it were at 59%. So the next thing I'm looking at, my mind goes to labor costs. So how are they being billed? What's being billed? So let's just say hourly, labor costs. What is my hourly labor cost? What is my front end and kitchen service? Who are my employees? What are they getting paid? How am I billing them? What's the retention rate on billing? And is there too much labor per person that I'm spending? Salary, non-salary. There's a lot of things that you can do that I can help you with too, with understanding your billing. And you're overbilling, you're giving them, they're being billed and they didn't actually work those hours, and or they did, but are those valuable hours that you should be billing? Should you be paying on overtime? Why are you paying on overtime at this part? Is it because of the busyness? Is it you didn't expect that, or you had to overcompensate? You really felt like paying someone more, but you couldn't do that, yet you did. So you have to understand all of that. And let's just say because we have 300,000 as our monthly revenue, it only makes sense we're over 100,000, roughly speaking, though there are those that are underneath 100,000 at 300,000. But a good mix would be at 100,000 plus. And I've seen a lot of P&Ls, balance sheets, cash flow statements. I've seen it all. So I'm telling you that I've seen a lot of these things and more. So you have to also account for fees and any waste. Oh, waste is huge, even bigger than any fees. What are you using your processor? What processor are you using? 3 to 5%, to 3.2% on average per transaction, not per transaction. What are you doing there? What's the volume? Because you have to also be prepared for absorbing those fees that slow down a business faster than anything else. The fees are what slow down businesses entirely. So they have to run the cost over to the consumer and hoping that they don't get paid and processed a certain way. If they had cash, great. Not, it's fine. Not always is cash better though. And just showing volume of payments. And then you can make that up elsewhere too, or you have to lower your processing costs, switch, and or don't use it so much, or only use it per certain transactions and sizes of those transactions, Are they bulk transactions? Are they wholesale transactions? Are they a bigger plate in this case for a restaurant and it has a higher price? And you know, though, that in a week, in a day, this is how much you generated of that revenue came from those plates. So out of those plates, how many people actually spent and charged through credit? And what were those costs for just using the cost to process? And then what costs were they to you? What costs were there to them? So are they really helping you? Are you really helping yourself? So understanding those things, very important. So let's just say that one here is 18,000. And again, I'm following the format of, let me give round numbers, even and odd. I'll switch from time to time, which you're about to see in a second. With that said, these are things that I had already thought of and calculated ahead of time. And a lot of this too, I'm very good with numbers. So this is the stuff that I do on the fly and I'm usually accurate, or it's whereabout in an estimate. But these are simple things to calculate. So now I know what my contribution margin is. How do I know that? You've seen the formula. So roughly said, when you take the contribution margin up here, being your revenue minus your variable costs, you would roughly see a contribution margin of 57,000 plus on that. So let's just say you have a 57,000 plus, which wouldn't always be round with contribution margin normally, unless you have, not just because you have other round numbers, but 57,000 plus in CM contribution margin or contribution margin, and that's your CM. So wanted to mention that, and that turns out to be a percentage of your total revenue and costs. That is roughly 20 to 19, 18, 19%, 19% plus. So your contribution margin now is running on 19% plus. But we haven't finished. I do need to go over a few of the other things to figure out, which are your fixed costs. Anytime you're starting a business, you're running lean or non-lean, you have to understand those variable and fixed costs. So you have your variable and fixed costs already set ahead of time, or you'll easily be able to predict that by generating this amount of revenue, as our revenue increases, this is what I'm going to have for a fixed assumed cost, a fixed assumption cost. If you don't know the exact cost, well, you should at most, but if the market's changing or you don't know from day to day, inflation or the pricing goes up per user or whatever the thing is that you have to find out about, then start off with something relatively close within that range. So now that we've done the labor cost, now we can figure out our fixed costs. Like we did with variable, we have more variable costs. Okay, I'm not showing everything, obviously, time and more. Obviously, there will be more things to look at. But with fixed costs, let's just say we have a 47, 46, 48, 49. Let's just do 48,000 from the last one being, what, 57%? 57,000, not 57%. And so we have 50,000 before, it's 57,000 before. Now we have a fixed cost of 48,000. That's our fixed costs, not variable. And then now we need our net profit. We got our gross margin. We know our gross profit. And from our profit, we know our margin. So if we are running at gross margin, being at up here, our 59%, we have 19% contribution margin. We need to figure out now our formula for net margin. And over here, you saw the net margin is equal to your net profit divided by your revenue. So to make things as fast as I can make them without getting into here's revenue total, here's all this other stuff. Let's plug in the formula here again and subtract this. From what those numbers are, you just simply would subtract those two, what we had at the top, and then you would roughly get around 9,000. Even number, let's keep it even number. So that would be then with the rest of the margin left and anything left over, that would be equal to 3.23%. So 3% is your equal to on your 3% equaling your net profit, or NPM, your net profit margin. And to keep it even, or I could say call it net profit margin percentage, incremental net profit margin percentage. There are different things there. So we still haven't looked at, though, what our actual debt payments are. So we know more or less about our revenue, how it goes. We know our gross margin. And different businesses have different ways that you add all into the gross margin. So just giving you one example of a restaurant. And what are variable costs, what are our fixed costs, and then any debt we have now and or will take on, like debt service coverage ratio. What is our debt now, and what do we need to have with additional net? Would that be able to cover the current debt? Or are we rolling over that debt and refinancing, consolidating? So let's just say we have our debt down here, debt owed or debt paid or payments. And our debt payments for this example, I'm going to keep it at, I'll do 44, 45. Yeah, 45. I like that number better, especially when there's funding. You normally see 45,000, then 44, 43. So I'll keep it at 45,000, not even 46,000. Not that even numbers have been less than an odd number, but let's just use 45,000. And for the free cash flow now, if you were, let's just do it this way. And there's different forms of cash flow that I haven't even explained just yet, but it's a difference now when you look at your formula up here again. So cash in minus cash out minus the debt. If I add all those numbers together, cash in, cash out, minus the debt payments, total debt, what I have amortized over a year and or monthly, but looking at it over total debt, then now I have a negative. That for sure I have a negative. This number. Yeah. So now I have about negative $36,000 on that, up rounded to 36,000. So what does that tell you without knowing anything more about cash flow? Is this business, this restaurant looks successful, but when you look at like we're break even, we're not even close to that break even. When you see that much in free cash flow being so low, then there's an injustification of why is this business still running? It's running way beyond fumes now. And so what it tells me is the business looks successful because it's got 300,000. It's got a productive gross margin. And a lot of restaurants don't see that margin increase much. They see a lot of margin decreasing. So if all those parts were stable, timing of receiving payments, timing of gross and net profit, contribution margin may vary more than anything else, though, because you're putting in the variable cost with your contribution margin. And that's what you need the most of, is that. And then the revenue can drop off, the variable costs can drop off together at the same time, or one over the other, significant difference. So now that could be most volatile. So again, it tells me that the business is successful. Let me make sure I have this open here. Okay. That it is successful on the surface. Not saying it's overall successful, but that 19% number you have to pay most attention to cannot absorb volatility easily. It's going to disrupt it. We spoke about volatility earlier and what that does, and where the volatility is being seen, ensued, and insinuated. Like, it's already not going into high volatile cash flow. So this is super volatile. And it can no longer bear to take anything in because it goes out as fast as it comes in. So it can not absorb the volatility risk, any seasonality, whether that seasonality is good or not, because everything else is not performing. So seasonality cannot make up for that. It's only going to be a symptom. And then it cannot make up for the debt. A lack of debt or lack of enough debt or whatever that is, it won't make up for that or any governance in that. So the funding itself didn't fail your business. In this case, I could give you more examples on if it would or wouldn't, why would it, and why wouldn't. But let's just say the funding is not what fails your business. It's not the debt that you take on. It's the marginal structure of the business. That 19% is not what I want. And I have to come back here and look at my fixed and variable costs. And I have to also look at other things, not just fixed and variable costs. Like what made that become the cost? And I got to look at everything, the complexity of that business and what is underused, what is underutilized, what are all the bills and payments, frequency and length and wavelength of those payments, and so much more. And so what I would do, if you ask me for this business, there's a lot of things that I would fix, a lot. But just to give you a few of them, this is just me giving you what I see here, is what's the pricing. I would always start with what's the pricing on the menu. Because if that's the thing that we can pull the lever on and increase most or change most and rapidly, and that's what's going to give us an additional amount of sales generated in a bucket of sales, like 3, 4, 5 sales extra in the day, 3, 4, 5 meals extra in the day, just by adjusting menu pricing. And it's not always that you've got to lower your price. It's become more relevant that the pricing is becoming lower. But not even that the pricing is what needs to be increased in a lot of cases, but just figuring out what can you consolidate, what don't you need on your menu, and what are the highest picks and lowest picks. And can you make that food maybe even better? That could be it. So menu pricing and a mix of things to increasing that, depending on your pricing, on your types of pricing and your products, I would generally look at increasing that by a mix of 4 to 5% on average, looking at the cost and the pricing. So increasing that by about 4 to 5, even 3.5 to about 5-ish%. And then the next thing that I would look at is labor. Obviously, I would look at the thing that I find the cost being high, but I don't always work high to low. You don't always want to work high to low. You want to work to what's been most efficient. So if it's inefficient, why is it most inefficient? It could be priced low, but be highly efficient, and you remove a part of your system and something breaks. And it wasn't about keeping more people as it was keeping your systems in place. Because if you can make up the amount of people lost, or even just a fraction, or just bear to do that, it'll be fine. And then what's my front end, back end labor, all total labor? Am I being efficient in that? So I would try to increase parts that were right if I had to fill a position. But if it wasn't about filling a position, I would look at reducing that by average 7%, 5 to 7%. And every business is different, so I can't say it'll be 5, 6, 7, 10%. It could be a whole overhaul. And that just has to happen. And you have a restaurant that has uniqueness to it, and you have a different revenue source where you can be fine without having providing a part of the restaurant with your labor being there so much. And the next thing I would look at, like I said, with waste, fees and waste, is just controlling that and reducing that spot. If my weighted average cost, I could say weighted average cost control decreases faster than the business revenue going down, okay, I can work more with that. But if I start seeing everything dipping, it's out of control, everything gets disrupted. Now you have to start from clean slate, from the bottom up. So I would look at any reducing and reduction of wasted product, inventory, too much shelf on the shelf life, too much overturn. This product doesn't get used as regularly as it did. you overspent just to have on stock, and then you have things on stock that most people don't buy, and it's just sitting there wearing out, and it's being thrown out, and all the produce, and making sure you're getting the right produce and vegetables, fruits, and not being so cheap, because people remember what that is, and looking at other areas instead of having to find the lowest cost alternative, because quality still does matter. And that's why people keep coming to you, unless it's not so quality and you're just trying to flip something for $1 and get that out and make your margin. Now you're going to have to get more people to meet your goals in a lot of cases. So that being the case, I would then look at coming back to my contribution margin up here. When I look at all of this right here, our index, and there's more formulas that I can put for you. When I look at the overall index and the changes I would make in each of those 3 categories, at least for now, and there's more fixes I can do, is that would then increase my contribution margin by an average of 8%. And if I can keep increasing my contribution margin from it being what it was, which was 19%, 57,000, and I can get to 26%, that's an additional about 20,000 plus. I have 78,000 now, roughly, that I've made in my contribution margin at 26% performance. I'd rather have that. And then my net profit, when I reshuffle those numbers, I'd have now an additional amount to be in total 22, 23. So I'd have around 30,000 for my net profit. In terms of free cash flow, opened up again from all that. What we had before was negative. So it wouldn't be negative anymore. It would be a complete turnaround. It wouldn't even be half of that. So it'd be negative 15,000. It'd be double on top of that, going positive into $15,000 plus in additional free cash flow, and having awesome net free cash flow from all of this. Now you can introduce your funding, and ISO should help, and not having to think always about break-even point and what that additional amount of debt will do. A few quick ones I do want to go over without. I'll actually let me give you another one. I'll go over here, and we'll follow the same formula for what we did. And I'm gonna, for this one, go into services at the home, like home services, contracting, subcontracting work, subcontracting work, and this one running on good margins. So let's just say contracting home services business. And we know what our contribution margin, we know what our differences are. So when I'm looking at all that, I'll be selective. And this one, I usually do see this number a lot. So let's just say revenue is equal to 220,000. Common number I've seen a lot. And let's just use that number. So then another round number I want to use for this is 120,000 cost of goods sold, again over 100,000 commonly seen, and a gross margin running simple math. And just put the percentage though for this one again. And yeah, like I could put the number for what that is every single time, but let's just simple mathematics, 45%, and when you would convert that number into percentage over your revenue. So that would be your 45% margin you're running from your revenue cost of goods sold, and what you get in gross margin from being 45%. Contribution margin, again, that's your CM. For this one, we have a round number again of 140,000 thousand. Then I'll have my fixed cost being another round number. Let's choose fixed costs here equal. We'll keep it in the same line. Well, like last time I separated them. So fixed cost there. And then NP, or net profit, be that 38,000. So from the debt payments, we have less than this one than we did with the restaurant, just by $3,000 difference. And actually, that makes a big difference, even if it's just 3,000 short. And not just the amount what you can use, but for interest payments and PR. And so free cash flow for this one, we're still in negative, but by not so much this time, unlike the 36,000. Let's just say it's 4,000, another round number. So those are just some of the numbers that I wanted to place there. Contracting, excuse me. My grammar, that. And so what I'm looking at from that, somewhat before, the business is profitable. That's good. But this tells me that their cash is arriving moderately late. Usually in a contracting business, that's what happens when you see that free cash flow, that number, even not so large, but that stacks up quick. When you do have jobs that keep coming in, or current jobs you're servicing, and those jobs are not giving you a return fast and they are spread out longer, then you end up putting more money into those jobs. So that free cash flow then becomes even more negative. And your numbers for your contribution margin would be completely different. You put what you put variable costs into those needs of those projects. So the cash is going to arrive late for this. And what I would say, having worked with a lot of contractors and home services, and this also applies in other businesses, is I want to know how often can you deposit? Because I need to know, of the total percentage you're depositing now, can you add an additional 40% in deposits? Yes or no? It's not easy to tell. How would those deposits arrive? How are they arriving now? With those extra jobs you have or will get, now I know that you'll be able to have from at least 2 of those 5 uptick. So understanding those deposits matter a lot too. The other thing is, do progress billing. I know that's not always best looked at when you have account receivable financing, progress billing type financing. Yeah, but from funders and lenders, that looks a little different from time to time. An expected revenue and expected cash and deposits coming in, and unfinished jobs and total invoice of those jobs. So how you bill through progress, that though would make a difference. So there's not something so compiled and large at one time. That makes a big difference, and I would look at doing that if you could, and your vendor agreements. And there's a lot of things that have to be looked at too. It's not just simply progress billing. And I'd likely want to do more of what I have. Like every week I check, or every day I would check what my cash is and on track to be, and forecast that cash every week. Before the weekends, I know, and then after that weekends, I know how much weekly cash I then need to forecast going forward. So if I do all of these things with the deposits, the weekly cash forecasted, the progress billing, I could see a major uptick in my cash flow increase. And it could be something as high as 15, 20, 30,000. That's the major difference between just doing 3 things, strategizing to fix and improve 3 things. And depends also on the jobs, when they get completed and all this stuff, and more moving parts. But when I look deeper, I'll be able to know more. So that's even without changing the revenue. because the last thing you need to pull a lot is the revenue lever. You don't have to approach it from what revenue I need to be generating, get more jobs so I can get better cash flow. And you're running on the same margins, contribution margin, net profit margin, but it's a completely different free cash flow and outcome to that cash flow just by fixing 1, 2, 3 things, one after the next. Start with this, do that, and go forward. So that's the case with many businesses. And I think I want to give you one more. I could go deeper and could be giving examples right now on positive free cash flow, but I wanted to make this about it being negative cash flow. Positive cash flow, you can start fixing more things and yeah, sure, make your cash flow even better. If you can make it better and figure out what that is, and I can help you with those things. So another example I want to just quickly go over without going too much into the details, trenches, is let's say you have an e-commerce type business, an e-commerce DTC type business, and it's upwards of about 560,000, 550,000, something like that. And following the same structuring, your gross margin is performing at 60%, roughly. Let's just use that as a round number. So you have to look at where you spend most and work way backwards, although you can start the opposite way, snowball, avalanche. And I'm going to run about 160,000 in total ads is what I'm running in my cost over a split period of time, monthly. So now what my contribution margin is, revenue variable cost, I have minus that 140, let's just round to 145,000. Let's say you're running at around 145,000. You have a difference of about 20%, 30% from your gross margin, your contribution margin, a lot of the times being less. You'll have 27, 25%. Let's just name it 25%. So after that, my fixed costs, I'll have 90-ish thousand, and my net profit, obviously less, and then your gross. So let's just run a 5 to 9 from that to my fixed costs. I'll say we have 50-ish, 52, 51,000 for our net profit. Your debt payments are larger. A lot of e-commerce businesses take fast funding quick. And as their sales go up, like the debt just keeps rolling in. So debt payments for that one, roughly 60,000. And through my calculations and my free cash flow, all that minus my debt, let's just say minus 12, minus 10, minus 10,000. Let's just say minus 10,000 to keep it round number. It'll come a little bit underneath that though. Minus 12, minus 10, let's just say minus 10,000. So what I'm seeing is I said this word earlier, customer acquisition cost with words. And let's just say my customer acquisition cost is roughly $80. And if that's inexpensive or expensive, it just depends on the business structure and the overall goal and what output the business is giving you, and to be running on the type of customer acquisition cost that it's running on. So now I know that my LTV, my lifetime gross profit, or LTGP, lifetime gross profit value per customer I'm generating from all this, and per sale, I'm getting $210. So let's just say it's a moderately higher priced e-commerce good. And so $210. So 78 to my 210, very not bad at all. 78 to 210, I'll take that. And so my payback period though, because we don't forget about our debt, right? This sounds good, but we got debt. So payback is in 3.5, 3 months, let's just say. So if I asked you, have you identified where your cash is locked? Where does your cash get locked? Just from what we went over today on this example. There are other ways I can tell you what it would be locked in, and other things that it could be locked in depending on the numbers. But it's locked into our ads and our inventory, our assets of inventory, our non-liquid, quickly non-liquid inventory, or we can liquidate and turn over. So we have our cash then locked in that inventory. What I would do first, although on those numbers, the 78 to 10, but because our cash is locked, we have debt, and then we have our money tied up in ads that we're putting the money in. If we haven't had a return yet on our ads, or quick enough, or the largest point, you're testing something new, becoming more innovative, and now you need more inventory. So you're adding to your inventory. You have a rotating inventory quickly, and didn't get all the other inventory out, or didn't make enough on that inventory. What I would have to do is definitely reduce by about, realistically reducing that, with those things considered, about a $10 spread on your customer acquisition cost. Make that number lower. I could do that by many ways. Understanding my conversions, my return on ad spend, the cost to everything that it takes to acquire that customer, all the spent in labor, or who's opening what accounts, and just going into it from that way and figuring out what all rolled over into the cost that we needed to do to make sure that customer at $65, $66 that we rolled down from $78 is sufficient. And then from that, of course, you always want to increase, when you decrease your customer acquisition cost, usually not always by automatic, but when you do reduce that, you do need to see your average blended order value from all platforms, or just in general on that one platform you're running on. What is my average order value? And my new customer acquisition, I can then determine better my average order value from those. And from my current clientele base, there's differences, I can do that there. And then I'm going to increase my average order value per person that spends, and that'll become in larger batches of things that they can buy. Smaller, but in a batch of things they can buy, and it's bundled all in as one thing. It could be one thing that is like wholesale cost or even retail, and they get better for their dollar spent, more value. Like, why get 3 when you can get 6? So I'm going to bundle in, and from a different category of, like, think of it when you take food to a party and you have different plates. So I'm going to have different bundles, and it's all going to like complement or substitute one another. So I'm going to have bundles, and there's different ways I can do that and have different is in added products, upsell, downsell, cross sell, but increasing my average order value and spend per customer. There's other things I can do there, but those are the fixes that I would look at first. And then I would look at what my inventory is doing and how quickly it cycles. So if I have to slow that down or increase it, then I'm going to look at the churn of inventory and the cycles and how fast that inventory turns. So if I do those things alone, looking at those separate numbers before on contribution margin, gross profit, and net profit, I remember them well. I have a good memory. Is I'm going to be running closer to about 180-ish thousand. Again, getting closer. It's higher than, a little bit higher than 180,000 with those other numbers I gave, because they weren't all that rounded or that equal to like 50, 60,000 of that. So it would be roughly around 180,000 plus that I'm going to have better in my contribution margin. For my net profit, I could see an increase closer to 90 495-ish thousand, which is plentiful than what we had before. So you're still running well on the revenue that you have. And then the free cash flow, we bumped that up now to about 30,000. Following also the last model for the last business, we have a higher influx of revenue that was added. So that's what I wanted to mention in that part for the contribution margin, net profit, revenue, gross margin, and free cash flow. And there's different parts of free cash flow. So what I would do is looking at a better way to fund your business. This is the part that I want to mention. Let me bring this to screen now. Oh, right here. And I did want to go over my social media. I didn't show that in the beginning. I was going to show you my LinkedIn. There's going to be a post that I made. So I want to read this, and I'll leave my social media stuff down below. But I have one right now open that I want to look at. Here, let me see if I can move this over to this screen. So I made this post not too long ago, from the time you're watching this video. Most businesses don't fail because they can't get funding. They fail because of this. They raise money before fixing their structure. Hi, family. As a business architect, meaning I design how businesses are structured, funded, and scaled. I go about what I do quietly, analytically, cerebrally, and behind the scenes, silent partner type. What I see constantly is this: no clear use of funds, no capital sequencing, weak margins masked by their revenue, debt stacked on top of confusion, growth before systems. Similar to what we mentioned, I can go in more detail, but I'm going to leave this as it is. Funding doesn't fix that. It amplifies it 100,000%, 100x. The businesses that usually scale, they do this first. They'll clarify their business model and vision, purpose, and all those, how money really moves and where they're moving to get more of that money, changing a few things of the clarity of that business or enhancing the clarity of that business. They will fix their structure, their meaning entity, their operational by ops, margins, and pricing. They will also map their capital properly, debt versus equity versus cash flow. They build systems before growth. Then they bring more money in intentionally. Focusing, I was going to say, funding is your output. It's not the strategy. Like I said, it's not even it's the pressure, not the oxygen. What's been the biggest blocker for you is a capital access or business structure. And just let me know on that one. That's what I had there. And then I had this one. Most cash flow problems I see aren't actually cash flow problems. They are this. It's timing and structural problems. I've been saying that all along in this video. Hi, family. I wanted to continue from my last post about why most businesses, they fail, which was because of raising funding before they fix their structure. Once funding enters a business before structure is clear, a few predictable things will happen. Cash comes in faster than clarity does. Way faster. Like, oh, I don't even know how to handle this and what to do with it enough. Payments will get layered over and over instead of being. Revenue looks healthy, but liquidity stays tight and really tight. As the owner, you feel busy, but actually becomes very stressful. More capital gets used to play a game of catch up and not move forward. This is where the MCAs, merchant cash advances type funding, short-term capital and quick money fixes, quietly turn from a bridge into a trap. If you've ever been there, you will know. As I do. Here's what strong businesses they do differently that you can adopt and absorb if you haven't yet or add to. They slow down before they speed up. They take the energy and time to understand these, where their cash flow and their cash is actually created, super important. Where it leaks, cash flow and overall money leaks. Which expenses actually they scale and which do not with your business. What type of capital fits the model? Important, very important. And which of those do not? The order of money should enter the business order of operations. So only then and only then does funding become more leveraged and not pressured. Capital is powerful. You just need to sequence it correctly. Out of sequence, it magnifies every weakness. That's why I always say the following from the perspective of being a business architect who designs how businesses are structured, funded, and scaled. Funding supports a specific and a unified strategy and never is the strategy itself. So I'm curious to hear from operators here. What's been harder in your experience? Is it managing your cash flow after funding, or is it knowing when your business is actually ready for it? And as I had there on the Happy New Year side. So one last thing I have here on my screen, besides you having my social media right now seen, I'm just doing it this way because of time. And if I have time, I'll show it. So I have here this document. So I'm giving you a sneak peek into my cash flow mastery system workbook. And again, I'll leave this for you down below in the description. But this is a right now 10 module workbook. And I even have the course version for this. So you can follow along there too. And I have videos made for every module. So every module builds on top of the next one. And you'll strengthen your critical thinking on cash flow. And not just, oh, here's how we input numbers. No, it's understanding cash flow, leveraged cash flow, and making sure that those numbers are being corrected and also assigned right. And you know how to think about something that comes up so you're not in a cash flow crunch or timing crunch with the thinking behind it. So that's what I wanted to leave you with in this video. There are more things I can show you that I had planned, but for time and more, why not keep going if I've already spent all this time, right? So I hope this video was of value to you and you understand everything we went through in the beginning, from cash flow sequencing, understanding contribution margin, how important that is, the different formulas to that one and the different formulas to the others. There are more formulas. There's complexity involved too with these things too. I get it. But I just wanted to show you that funding is there. There's creative credit back, cash flow, creative credit back, cash flow, collateral, equity, real estate in the mix, cash out refinance, and other forms, HELOC, and more out there that you can use to fund your business. And when I know what your uses of funds are and your business model, I can line that up even better. And there's more that I would have to know and obviously pay attention to. So down below in the description, I'll have more information. I appreciate you. Thank you for watching. And let's have a great 2026 and beyond. If you have any questions, comments, or concerns, please reach out to me, voice them to me. And I'll leave in the description. And or if there's a comment, if you want to comment, you can too. Feel free to share this with anybody. And if you feel like they will find value from it, if you have, hopefully have. And if you haven't subscribed, please go ahead and subscribe and click the bell notification icon so you do not miss any future content on what I said and showed you today and or anything else. So that's everything from me. Thank you.